For AM Best TV, I'm Diana Dora here at the 29th East Asian Insurance Congress in Manila. And joining me now is Stefan Holzberger, Chief Rating Officer at AM Best. Stefan, great to have you with us.
Thanks for having me.
How would you assess the performance of the reinsurance market in 2017?
Well, 2017 was certainly an extraordinary year for the segment. The cat losses posted on an economic basis as well as an insured basis were well over double the 10-year average. But by and large, the reinsurance sector was prepared for such a year. The losses came in line with modeled expectations. They were in line with the overall risk tolerances of the individual reinsurers competing in the market. So at AM Best, although it was a really tough year from a loss perspective, we didn't downgrade any companies based on their performance last year.
So last year there were significant catastrophic events, as you mentioned. How did that impact current market conditions?
Right, so if you kind of rewind back to the fall of last year, there was this sentiment that after so many severe cat events in peak markets that we would see a real bounce in rates and a kind of tightening of terms and conditions. And there was probably some optimism in those statements. And as we kind of got a little closer to 1/1, it started to become quite evident that we weren't going to see the kind of rate increases that we were hoping for. And that's largely due to the intense competition that we've talked about for a number of years and has been really kind of the driving force in terms of pushing rates down year over year and broadening terms and conditions. So with third-party capital coming in strong, last year, reloading capital for 2018, we just really didn't see that nice bounce in rate increases, and the expectation for June and July renewals in the cat-hit areas of Florida, Texas, Puerto Rico, we're expecting really kind of probably single-digit rate increases even for programs that were loss affected. So it really speaks to the intense competition in the market and the ample amount of capacity that's available.
And if that competition continues to heat up, particularly in markets, say, like India, what are the expectations going forward when it comes to increases? Will it remain flat?
I think unless we have a mega catastrophe, and there we're talking about $150 billion, $200 billion single event in 1 year, those insurance companies, reinsurance companies in the market, they're looking for opportunities to grow their business. They certainly don't want to see the top line fall away. Their investor expectations are for steady growth. And, you mentioned India, China. Certainly there are markets with strong growth opportunities, and we're hearing a lot about that at the EAIC conference this week. But when you look at the global scale, the large mature markets where the vast majority of premium flows through for these large global players, there just really are perhaps not enough growth opportunities to put that excess capital to work. And so long as you have so much capital that's looking for a home in terms of writing business, it's going to suppress rates.
Where do you see the market headed, and what will be the driving factors?
Right, so we have a negative outlook on the global reinsurance market segment. We've had a negative view for a number of years now, and as I mentioned, it's really not a question of capacity or capitalization that's available to be deployed in the market. It's all about performance. And talk about looking forward over the next couple years, what we really expect to see is just that pressure on the reinsurance sector's ability to achieve an adequate return in relation to the risks that they're taking on to their balance sheet. So, really that's the issue. We've seen very favorable reserve releases help earnings over the last several years. Interestingly, in 2017, there was a dip in reserve releases, and that might be just companies saying, well, it's going to be a loss year. The AM Best Global Recomposite posted a 110, so maybe they're trying to keep that powder dry for this year and going forward in terms of maintaining those reserve releases. But talking about what might move our outlook from negative to stable, it's really going to be a question of what can we see in terms of an improved risk-adjusted return. Interest rates are slowly ticking up, and that's good news for investment income. That side of the equation would certainly help the reinsurers if that continues to move up at a steady pace. And also you have the potential for the risk-adjusted rate to rise so long as the prudent margin in terms of underwriting profit stays at a pretty relative stable spread above that risk-adjusted rate. That could be good news for technical profitability as well, but we'll really have to see how that plays out.
What would it take for AM Best to change its market segment outlook for global reinsurance from negative to stable?
Well, really, as I said, I think it's really all about the profitability of the sector, right? Capitalization is well supportive of the credit quality that we've assessed the segment today. The profile of these organizations, as we know through M&A, their size, their scale, their diversification, their attractiveness to the big brokers that are a source of course, the vast majority of business that flows into this segment, attractiveness to third-party capital, which we know is really here to stay in terms of their interest in insurance as an asset class. You really have that dynamic of, can these organizations, achieve that profitability? They have the capitalization, they've got the profile globally. It's really all about that risk-adjusted return that's falling short and to this point trending in the wrong direction.
Stefan Holzberger, many thanks for your insights.
Thanks for having me.
For AM Best TV, I'm Diana Dorothy at the 29th East Asian Insurance Congress in Manila.